6 years ago, $12 could buy you a burrito, a drink, and you'd still walk away with change in your pocket. Today, $12 barely covers the burrito alone. Back in 2019, a standard restaurant burrito cost $8.50. Today, that same burrito, same rice, same beans, same guy rolling it behind the counter costs $12. Nothing about the burrito changed. Something about your money did. Here's where it gets uncomfortable. Let's say you had $50,000 sitting in a regular savings account back in 2019. You did everything right. You didn't touch it. You didn't spend it. You let it sit there safe and insured exactly the way your parents told you to. Back in 2019, that $50,000 could have bought you roughly 5,800 burritos. Today, even with a little bit of bank interest added on top, that same $50,000 can only buy you about 4,100 burritos. Somewhere between then and now, nearly 1,700 burritos worth of value simply vanished. Nobody broke into your account. There was no fraud alert, no thief. It disappeared quietly, a few cents at a time, every single day, while your money sat there feeling perfectly safe. That silent thief has a name, and by the end of this video, you're going to understand exactly how it works, why almost nobody protects themselves from it, and the exact steps to make sure it never quietly drains your future again. If that story just made your stomach drop a little, good. That means you're paying attention, and that means you're exactly who this channel was built for. Before we go any further, hit that subscribe button right now, because on David Marshall Finance, we take confusing money topics like this one and turn them into something simple you can actually act on. And if you're new here, welcome. I'm David Marshall, and my job is pretty simple. I take the language of Wall Street and I translate it into language a normal working person can actually use. No suits, no jargon for the sake of sounding smart. Just honest, clear explanations of how money actually works, because nobody ever sat us down in school and taught us this stuff, and that's exactly the problem we're fixing today. Now, I already know what some of you are thinking. Investing sounds complicated. ETFs, PE ratios, ticker symbols, limit orders, it can feel like a foreign language designed specifically to keep regular people out. I felt the exact same way when I started. But here's the secret nobody tells you. All of that vocabulary takes about 20 minutes to actually learn. 20 minutes, and then you have a skill that protects and grows your money for the rest of your life. So stick with me, because by the time we're done, you're going to understand more about investing than most adults in this country ever will. Let's go back to that burrito for a second, because this was never really about burritos. It's about a much bigger question. If a regular savings account can't protect your money from that invisible thief, then what actually can? To answer that, let me tell you about two people. We'll call them Sarah and Marcus. Both of them had roughly the same amount of savings a few years back. Sarah did what most people are taught to do. She kept her money safe in the bank. Marcus did something different. He took a portion of his savings and invested it. We're going to check back in on these two a few times throughout this video, because the gap between their decisions is going to get bigger than you might expect. So why would Marcus choose investing over something that feels safer, like real estate? After all, everybody says buy property. Real estate always goes up. Here's the problem nobody mentions. Real estate is incredibly illiquid. That's a fancy word, but it just means how quickly you can turn something into usable cash without losing value in the process. If Marcus needed his money back in an emergency, selling a house isn't a same-day transaction. It typically takes 30 days or more just to close, and that's assuming he already had a buyer lined up, an inspection completed, and financing approved on the buyer's end. 30+ days while bills are due tomorrow. That's a long time to wait when life throws you a curveball. Now compare that to public stocks. Public stocks are one of the most liquid assets on the planet. You can buy a share in the morning before your coffee even gets cold. And if you needed to, you could sell that exact same share by the afternoon and have the cash hit your account within a couple of business days. That single difference, liquidity, is a huge reason why stocks are often the most accessible starting point for a beginner. You're not locking your money into a 30-year mortgage or a piece of property you have to maintain, insure, and eventually find a buyer for. You're buying a small piece of ownership in real, recognizable companies, and you can adjust your position whenever life demands it. But liquidity is only half the story. The other half is predictability over time. And this is where I want to show you something that should genuinely change how you think about your future. Picture this, it's 1980. Gas costs about $1 a gallon, and somebody decides to take just $100 and invest it into the overall stock market instead of spending it. No additional contributions, no topping it up. Just $100 left alone, writing out every up and down of history for over 4 decades. Today, that same $100 would be worth approximately $17,000. Read that again, $100 turning into $17,000. That is not a lucky lottery ticket. That's not some meme stock gamble. That is simply what happens when you own a small slice of the American economy and let time do the heavy lifting. Compare that to inflation over the same period, and that $100 in the market grew roughly 44 times faster than inflation ever could have eroded it. This is the exact opposite of what happened with those burritos. Instead of value quietly disappearing, value was quietly compounding year after year in the background while nobody was watching closely. I know what you might be thinking right now. Okay, David, that sounds great for someone who invested back in 1980, but what about someone starting today in 2026? Isn't the market too high right now? Aren't we due for some kind of crash? Stick with me because this next part is going to matter more than almost anything else in this entire video. Here's a number that shocks almost everyone the first time they hear it. Historically, the stock market, specifically the S&P 500, closes at an all-time high on roughly 8.3% of all trading days. That works out to about 21 days every single year where the market literally sits at its highest point ever recorded. Think about that for a second. If you waited for the market to feel safe, to feel like it wasn't sitting at some scary new peak, you would be waiting most of your investing life because new highs happen far more often than people assume. The market sitting at an all-time high is not automatically a warning sign of a coming crash. Historically, it's simply a normal, healthy symptom of long-term growth. But here's the part that really separates people who build wealth from people who stay stuck on the sidelines forever. What happens if you try to be clever and time your entry, jumping in and out trying to dodge the scary days? Researchers have studied this extensively and the results are honestly staggering. If you missed just the 10 single best trading days over multiple decades, you would erase 54% of your total gains. Miss the 20 best days and you erase 73% of your gains. Miss the 30 best days and you wipe out 83% of everything you could have earned. And here's the terrifying part. Those best days almost always happen right in the middle of the scariest, most chaotic-looking downturns, exactly when panicked investors are pulling their money out in a rush. The people who tried to be strategic and dodge the bad days ended up accidentally dodging the best days too, because you genuinely cannot know which day is which in advance. This is exactly why one of the most repeated phrases in personal finance exists for a reason. Just keep buying. Market high or market low, just keep buying. Remember that phrase because we're coming back to it more than once today, since trying to outsmart the market's timing almost always backfires, while consistently staying invested almost always wins. Alright, let's check back in on Sarah and Marcus for a second. Remember, Sarah kept her money in the bank, safe and untouched, exactly the way she was taught. Marcus took a portion of his savings and put it into the market and simply left it there, riding out every bump along the way without panicking. We're going to come back to their final scoreboard at the end of this video, and trust me, the gap is going to surprise you. Now that you understand why stocks make sense, let's actually get into how you set this up, because knowing the theory means nothing if you don't know which buttons to click. The very first decision you'll make is choosing between two different types of accounts. Think of these as two separate containers you can pour your investment dollars into. The first is a retirement account, something like a 401k through your employer or an IRA that you open yourself. These accounts come with a beautiful tax advantage. In many cases, the money you put in reduces your taxable income for the year, and it grows without being taxed year over year. Financial folks call this a tax-sheltered account. The trade-off is liquidity restrictions. In most cases, this money is designed to stay locked away until retirement age, and pulling it out early usually comes with a penalty. Think of a retirement account as a kind of forced savings vehicle for your future self, one that's genuinely hard to raid on a whim, which honestly is a feature, not a flaw, for most people's psychology. The second container is a standard brokerage account. This one has no restrictions on when you can take your money out. You can buy, sell, and withdraw whenever you want, no questions asked. The trade-off is taxes. Whenever you sell an investment for a profit inside a standard brokerage account, that's called a realized gain, and the government taxes that gain. The key word there is realized. As long as you hold on to your investment and don't sell it, you're not paying taxes on the growth yet. So which one should you use? Most financial advisors will tell you to think about your target horizon, meaning how far away is the goal you're actually saving for. Money for retirement decades away generally belongs in that tax-sheltered retirement account first. Money you might need sooner for a house down payment, a wedding, a business opportunity generally belongs in a standard brokerage account where you keep full flexibility. This actually connects to another important concept, risk profiling by age. When you're younger, you can be riskier because you have decades of time to recover from any downturn along the way. As you age, adjust for preservation, meaning you gradually shift your portfolio toward more stable, conservative investments as retirement gets closer. A 25-year-old and a 62-year-old should never really have identical portfolios because their target horizons are completely different. Okay, now let's talk about what you're actually buying inside these accounts, because this is where a lot of beginners get intimidated, and honestly, they really shouldn't be. You've probably heard the term mutual fund and the term index fund thrown around like they're interchangeable. They're not. A mutual fund is typically actively managed, meaning there's a professional fund manager sitting behind a desk somewhere, making decisions about what to buy and sell, trying to beat the overall market. Sounds great in theory. The problem is those fund managers charge fees for that active management, and study after study shows that the vast majority of them fail to beat the market over the long run anyway. So you end up paying more for a lower chance of success. An index fund flips that entire model on its head. Instead of paying someone to guess which stocks will win, an index fund simply and automatically tracks an entire index, like the S&P 500, which represents 500 of the largest companies in America, or the NASDAQ, which is heavily weighted toward technology companies. Because there's no expensive human trying to outsmart the market, the fees are dramatically lower. And remember what we just learned. Trying to time and outsmart the market usually backfires anyway. So an index fund essentially automates the exact behavior that actually wins in the long run: steady, broad, low-cost ownership of the entire market, instead of a risky bet on a handful of individual picks. An ETF, which stands for Exchange-Traded Fund, is simply a basket of investments, often tracking an index just like we described, that you can buy and sell throughout the day just like a regular stock. This is different from a traditional mutual fund, which usually only updates its price once at the end of the trading day. For a beginner, ETFs that track major indexes are usually the simplest, lowest cost, most beginner-friendly way to get exposure to the entire market in a single purchase. Now here's a concept that trips up almost every beginner the first time they open a brokerage app: the ticker symbol. I want you to think of a ticker symbol exactly like an airport code. When you fly, you don't say "I'm flying to the airport" with the long, complicated official name. You say "I'm flying into JFK" or LAX or ORD, short, simple, universally recognized codes. Stocks work the exact same way. Apple's full corporate name doesn't get typed into your brokerage app every time you want to buy it. Instead, you just type AAPL, Microsoft becomes MSFT, Tesla becomes TSLA. And for our index fund example, the Vanguard S&P 500 ETF, one of the most popular ways to buy the entire market in a single purchase, goes by the ticker VOO. Another extremely popular S&P 500 tracking ETF goes by the ticker SPY. Once you see a handful of these, your brain starts recognizing them instantly, the same way you instantly recognize LAX means Los Angeles. It stops feeling like a secret code and starts feeling like a normal part of your vocabulary. The more you understand, the less scary it becomes. Now let's talk about something that scares beginners more than almost anything else on this list: the price-to-earnings ratio, usually just called the PE ratio. I want you to stop thinking about this as some intimidating Wall Street formula and instead think of it simply as a price tag. When you walk into a store and see a jacket, you instinctively judge whether it's expensive or cheap relative to similar jackets around it. A PE ratio does the exact same job for a stock. It's telling you how much investors are currently paying for every dollar of a company's earnings. A higher number can mean investors expect strong future growth, or it can simply mean a stock is priced expensively. A lower number can mean a bargain, or it can mean the market has doubts about that company's future. That's really it. It's a price tag, nothing more mystical than that. Here's where this actually gets useful for you as a beginner. There's a well-known framework from finance writer Nick Magially, from his book called Just Keep Buying, and the data behind it is honestly liberating once you understand it. When you look at historical stock market returns over a 20 to 30-year holding period, something remarkable happens. The specific price you paid on the day you bought in, whether the PE ratio looked expensive or cheap at that exact moment, becomes almost irrelevant. Historically, there has never been a 20 to 30-year rolling period in the market that produced a negative real return, meaning if you held on long enough, time itself repaired almost any bad timing decision. Let me give you a real example of why this matters so much. Rewind back to 2012. At that time, the market was sitting around 1,400 points, and a huge wave of analysts and everyday investors were convinced it was dangerously overvalued, some claiming it was 50% too expensive and due for a massive correction any day now. People sat on the sidelines waiting for that correction, terrified of buying at what felt like the top. What actually happened? Over the following years, that same market didn't crash at all. It surged roughly 4.5 times higher. The people who waited for the perfect entry point missed one of the greatest wealth-building runs in modern market history, all because they were staring at a price tag instead of trusting the long-term horizon in front of them. This is exactly why the phrase matters so much. Just keep buying, market high or market low, just keep buying. Not because timing never matters at all, but because your odds of correctly guessing the perfect moment are far lower than your odds of simply staying consistently invested for decades at a time. So how do you actually put this into practice without needing a finance degree to feel confident about your timing? This brings us to one of the most psychologically important concepts in this entire video: dollar cost averaging, often shortened to DCA. Dollar cost averaging simply means investing a fixed amount of money on a regular schedule, regardless of whether the market is up or down that particular day, instead of trying to invest one giant lump sum all at once. Let's say you decide to invest $200 every 2 weeks. Some weeks the market will be up and your $200 buys slightly fewer shares. Some weeks the market will dip and that same $200 suddenly buys you more shares at a discount. Over time, this smooths out your average purchase price and removes the emotional guesswork of trying to pick the one perfect day to buy. Here's why this matters so much psychologically, maybe even more than it matters mathematically. The biggest obstacle to investing success usually isn't a lack of money. It's something researchers call psychological resistance, the fear and hesitation that creeps in right when the market gets scary, tempting you to pause your contributions at the exact worst possible moment. Automated dollar cost averaging removes that decision from your hands entirely. The money moves on autopilot, on schedule, whether headlines are screaming about a crash or celebrating a rally. The system already decided that for you in advance, and that emotional relief alone is often the real difference between someone who builds wealth over 20 years and someone who panics and quits after the very first scary headline. Alright, let's actually walk through what this looks like inside a real brokerage app, because theory only gets you so far, and I want you to actually be able to do this today. Once you've opened either your retirement account or your standard brokerage account, and you've selected an index fund or ETF like VOO, the first thing you'll notice is that most modern platforms let you buy fractional shares. This means you don't need enough money to buy one entire expensive share all at once. If a share costs $400 and you only have $50 to invest this week, you can simply buy 0.125 of a share. This single feature is exactly why the old excuse of not having enough money to invest doesn't really hold up anymore in 2026. Next, you'll set up your recurring investment. Inside almost every major brokerage app, there's a section for automatic or recurring investments. This is where you plug in your dollar cost averaging plan. For example, you might set $200 to automatically transfer and invest every 2 weeks, right after payday hits your account. Set it and genuinely forget about it. This is forced savings in action, removing the temptation to skip a contribution just because something else feels more urgent that week. Finally, when you do decide to place an individual trade yourself, you'll typically be asked to choose between a market order and a limit order. A market order simply means buy or sell immediately at whatever the current price happens to be right now, no waiting around. This is the simplest option and usually the right choice for most regular recurring investments. A limit order works differently. It means you're setting a specific target price, and the trade will only execute if the stock reaches that price or better. For example, if a stock is trading at $52 but you only want to buy it if it drops to $50, you can place a limit order at $50 and the platform will automatically execute the purchase only if that price is actually reached, without you having to sit there refreshing the screen all day. Now let's finally check back in on Sarah and Marcus one last time, because I promised you the gap between their decisions would genuinely surprise you. Sarah kept doing exactly what she was taught, playing it safe, letting her savings sit untouched in the bank, watching burritos and groceries and rent quietly get more expensive while her balance stayed the same. Marcus took a portion of similar savings, set up automated dollar cost averaging into a simple low-cost index fund, and then did something incredibly boring. He just kept buying. Market high or market low, he just kept buying month after month, year after year, letting fractional shares and recurring contributions quietly do their job while he lived his actual life. Years later, the difference between their two accounts isn't a small gap anymore. It's the difference between someone whose money quietly lost value to an invisible thief and someone whose money quietly multiplied while they weren't even watching closely. That's the entire secret hiding behind everything we talked about today. Not some genius stock pick, not some secret insider tip. Just understanding what inflation actually does to cash sitting still. Understanding why liquid assets like stocks give you flexibility real estate simply can't. Understanding index funds and ticker symbols and PE ratios well enough that they stop feeling scary. And then simply automating the boring, consistent habit of dollar cost averaging and letting decades of time do the heavy lifting. The more you understand, the less scary it becomes. And now you understand more about starting your investing journey in 2026 than most people around you ever will. If this video helped make investing feel less intimidating and more like something you can genuinely start this week, hit subscribe, because every single week on David Marshall Finance, we're breaking down exactly this kind of topic, the stuff nobody taught us growing up, explained the way it should have been explained from the very beginning. I'm David Marshall, and I'll see you in the next one.